it's time to begin, so let's get started. My name is Brien Lundin. I publish and write Gold Newsletter. I have the annual New Orleans Investment Conference. I have to say that John Kaiser came up before me. He was the last speaker, and I completely agree 100% with him on the future of gold prices that are going higher, and I completely disagree 100% with him on why they're going higher. I am an unabashed gold bug. I am still worried about gold, and I am worried about the debt. In fact, that is the primary reason why I say higher gold prices are inevitable. And as far as what you need to do about it, we're going to highlight some companies at the end of this presentation, and those represent very good ways to take advantage of this trend. But this trend is inescapable, so let's take a look at some of the reasons why. Gross federal debt. This is a trend going back. This chart goes back to 1900. This is gross federal debt in the U.S., of course. But the trend line growth rate back to 1900 is 8.7539%. Now, if you could have invested in that trend line back then, God knows how much money you would have compounded over the years. But the point is that this is an irrefutable, inescapable trend line growth. And as you can see here, that bump right there where it took a bump, well, that kind of coincides with the establishment of the Federal Reserve. Coincidentally, of course, I'm sure. But the point is that governments throughout history do this. They overspend, they create debt that they can't handle, that's too big of a burden, and they depreciate their currencies to take advantage of. But I don't want to get too far ahead on that. Let's talk about some dirty little secrets on the federal deficit and debt. Okay, the federal deficit for 2018 came in at only about $793 billion, and people were screaming about that. That's nearly $1 trillion. This is terrible. We're going to have trillion-dollar deficits. Well, the fact is, for the fiscal year 2018 that was ended September 30th, the federal debt had grown $1.2 trillion over the previous year. Nobody's talking about that. $1.2 trillion. The debt does not grow purely from the growth in the annual deficit. There's also about $400 to $500 billion in off-budget spending. Illegal for companies to do, but perfectly legal for the entity that writes the laws. And you don't see that talked about. That's $400 to $500 in entitlement spending, et cetera, that gets lopped onto the debt every year, but doesn't get reported in the deficit. As a result, the federal debt's already growing much more quickly than most people realize, and it's accelerating. The debt grew $1 trillion in just the last 6 months of fiscal 2018. So 6 months, $1 trillion, not that it's going to hit that, but that's a run rate of $2 trillion a year. And nobody's really talking about that again. Analysts are decrying the fact that the federal debt will grow to $30 trillion in the next 10 years. The Fed and the CBO put out this report trying to scare the pants off of people by saying that the federal debt's going to grow to $30 trillion in 10 years. The fact is, at its historic growth rate, it's going to reach that $30 trillion within the next 3 years. And that would be a shock to the system. The fact is, the federal debt is already out of control. So what does this mean? Once again, this is nothing new. This is not something that's just happened in the United States. It's not something that's just happened in modern Western democracies. It's not a recent phenomenon. This has been going on for 4,000 or 5,000 years. This is human nature. When a government, every government in fact, has always overspent its means, whether through wars, through entitlements, bread and circuses in Roman times, they've always overspent their means. And the prescription to take care of these debts that are too large to handle any other way, that can't be handled through growth, can't be handled through higher taxation, that can't, God help us, be solved through cuts in spending, because that'll never happen. The only way that they can address these debts is to depreciate the currency in which they are denominated. So Cicero By this time, by Cicero's time, it was already a well-known, established trait of human nature. And one of the things Cicero says, to be ignorant of what occurred before you were born is to remain always a child. Well, he was warning at that point in time of overspending in the Roman Empire. And after he was executed, actually, things kind of got into overdrive. Here's the devaluation of the Roman denarius. This is a great chart by the visual capitalist people who do a fantastic job. But if you can see here, this precipitous decline here, that's a loss of somewhere around 85% of the purchasing power of the denarius in about a 50 or 60 year time frame. These little red circles here are Roman emperors that were deposed. They typically were not retired and sent off to pasture, but they were removed from office, let's say. And that's what happened. Now, people say that's fine. You know, historians look at that and they say the Roman currency was destroyed during that time period because they're looking at the grand sweep of history, losing 85% of your purchasing power in 50 or 60 years. Well, that's obviously the sign of an economy, of a nation, a civilization on the verge of collapse. So here's the purchasing power of the consumer dollar. This is 1965, which is, again, not coincidentally, that's the year that the United States removed silver from U.S. coinage. That was the last little vestige of precious metals in the currency. Now, we could have started this with FDR. We could have started it with 1971 at the closing of the gold window. But I chose 1965. I thought that was an interesting period when precious metals were completely removed from the U.S. currency. Over that 55-year or so time frame, the U.S. dollar has lost 87% of its purchasing value. Now, that's remarkably similar to what we saw happen with the Roman denarius. Now, where we go from here, I don't know. We have elections. That's how we depose our leaders in that case. But this has not really been an issue. Nobody's really worried about this. Let's face it. It's like the frog in the pot of water that's progressively getting warmer, isn't quite boiling yet. Nobody's really worried about it. I think that time's going to come to an end. But again, let's look at what's happened. So going back briefly, this is what's happened with the dollar from upper left to lower right. And this, over the same time frame, is what's happened to gold, lower left to upper right. Now, of course, we all lived through some painful periods in here, but generally speaking, lower left to upper right. So a lot of people talk about gold. It's not really correlated to inflation. It's not the best inflation hedge because of that. It's gone up and down. Stocks have beat it. That's all a bunch of BS, basically, because what gold is and always will be it's a monetary asset. It's insurance that really comes into play and gets bid up when people get worried. So if you look at some of these periods, whenever people get really concerned about the economy, the late 70s, around 2008, or really early 2000s and the last little run-up after the 2008 crisis, people get worried, they buy gold. It works every time because gold is the historic. Over that 4,000 to 5,000 years of history, it's been the one thing that has preserved wealth throughout these crises, throughout these depreciations of fiat currencies. It's going to happen again. Let's look at a couple of things, reasons why I think we're reaching an inflection point, a crisis point in the U.S. federal debt. Here I've graphed federal debt versus interest expense. And interest expense is the red line. So here you see the federal debt. No, federal debt's the red line. Interest expense is the blue line. So here you see after the 2008 crisis when the Fed really started monetizing debt and we had all this spending. Of course, 5,000-year lows in interest rates only encourages more debt creation. Debt soared, and then because rates were low the interest rate payments were kind of sideways, but then just a little bit of an uptick in interest rates has led the interest payments to start to explode. What I've done is, and I struggled, I couldn't find out what is the federal government paying in interest on the federal debt. It's hard to pin it down because all the sovereign debt out there is different maturities, et cetera, different rates. Nobody that I could find really did this, so I just simply went to the Fed site and I divided the annual interest payments by the annual federal debt. And this is the interest rate burden that I came up with. And it varies a lot. When you have zero rates, then the numbers get all out of whack. But when things are fairly normal, the effective interest rate on the federal debt is usually about 3 to 4 points above the Fed funds rate. So what does that get us? Well, the Fed is trying to get to at least 3% on the Fed funds rate, trying desperately to get there because they need to, you can't do much to influence the economy by cutting less than 3 points on the Fed funds rate. That's the minimum. And typically the average in a rate-cutting environment, the average cut in the Fed funds rate is 5%. So we're sitting here at 2.25%, and the Fed desperately wants to get to at least 3 to 3.5%. Here's why they can't do that. If they get to 3%, let's say, on the Fed funds rate, if the effective interest rate on the federal debt, again, remember, a lot of this debt creation comes from this $400 to $500 billion automatically every year that gets added onto the debt. If they get to 3% on the Fed funds rate, that means the effective interest rate on the debt is going to be 6 to 7%. Let's look what that is. That's about $936 billion. At 7%, it's about $1.1 trillion. And that's just interest. In effect, they're borrowing money to pay the interest on their loans. Now that's just a compounding downward spiral. Now of that $1 trillion or so that they'll be paying in interest on the federal debt, a significant portion of that is going to be going to China and some other places that are not in the U.S. I don't think that's going to be politically palatable. I think there has to be some kind of an accommodation, some kind of a significant devaluation in the dollar to account for that. The only thing that remains in question is what the degree will be. Now, we're not the only ones. Every other major Western economy and some non-Western economies, every other developed economy is going through the same thing. They've created monstrous debt loads. So if the dollar has to be devalued, is it going to be devalued against the euro or the yen or the pound? They're all being devalued as well. It's a race to the bottom of the hill as far as the eye can see. No, they're all going to have to be devalued against tangible assets, gold primarily, silver as well, real estate most likely, tangible things. Their prices will rise because the values of the corresponding currencies, what they're priced in, will be falling. Now, gold tends to overshoot in that kind of an environment. So it tends to, again, if you look at that chart, that's where you get those big peaks in the gold price, is when people really get worried. Gold overshoots. And so what I'm showing you here is something that's inevitable. I mean, can anybody think of any way that this increase, this trend line in the U.S. debt is going to moderate or slow down or get paid off? I mean, there's no way. We're not going to be able to raise enough taxes. We can't grow our way out of it, and there's no way that spending is going to be cut. In fact, one of the reasons why I think gold has enjoyed a bit of more enthusiasm in recent weeks is the simple fact that now we have a new Democratic Congress coming in. And they're talking about, they've already eliminated some of the pay-as-you-go speed bumps on spending. And so we're going to have dramatically higher spending coming out of Congress because neither the Democrats nor the Republicans are going to stand in the way of that. They like to bring home the bacon, so they're going to keep spending. So This is inevitable, and it's going to keep happening. So here, let's take a look at where gold is right now. Of course, this is the long-term history. We had a great run in the 2000s through about 2011 with a little speed bump around 2008. And most of you here, I would think, remember that era. You remember the money that was made through companies like those out there in the exhibit area and up here at the panel. You know the kind of profits that were made then. There was tremendous move in gold over that period, but there were all sorts of profit opportunities, tremendous profit opportunities in junior resource stocks. The gold stocks, the silver stocks, the exploration stocks were going up 3, 4, 5, some of them 10 and 20 times in value. You had a rare earth bull market. You had a run in copper. You had a uranium mania. You had all these associated bull markets, but they were all against the background of a gold bull market. I think we're going to have that again. Let's look at something else here briefly. This is gold over the last few years, actually from about late 2015 to date. These arrows mark all of the Fed rate hikes. And as you can see, without exception, gold moved up after every Fed rate hike. It also moved down in advance. This is a trader's mentality, the paper gold market being pushed around, people going long the dollar, short gold in anticipation of a rate hike, then selling the news after they bought the rumor once the Fed rate hike occurs. The only exception was this past June when we did not see, when gold actually kept falling after the Fed rate hike, and that was, as you remember, when Trump was really ratcheting up the tariff talk and everything else, and the dollar was strong as a result. So I think that was a real anomaly. Another important thing to note here is that every year since December, every December since 2015, the Fed has forced in a last-minute, end-of-the-year rate hike, and these have historically, have always, in fact, prompted a bull market, a rally in gold. Every time at the end of the year, we've had that kind of a rally. In early 2016 and in 2016 and 2017, that rally was really pretty good, 2016 especially. They both lasted until about the summer, then we had summertime weakness, etc. Last year, that rally, that January rally in gold, only lasted about a month. Only lasted through January. Then the metal pretty much traded sideways till April. Then we started to see the trade rhetoric heat up. We saw the dollar strengthen, and that was the end for gold. It kind of slid throughout the remaining end of the year. I've been predicting and preaching from the rooftops that we were going to have a rally this year once again in gold right after the Fed hiked its rates, and that's exactly what we've seen. The question now is, are we going to have a 2016, 2017 kind of a move, or is it going to be like 2018, like we saw last year? Remains to be seen. Frankly, I'm a bit concerned about it. I really don't know. I know an expert isn't supposed to stand up here and say he doesn't know, but I don't. The next 2 weeks are going to tell the tale, frankly. We're going to find out whether this little pause we've seen in gold and the gold stocks is going to last, or whether we're going to have some momentum, whether we're going to pick up steam again. This is a 3-month chart. You can see we've kind of topped out. We can't get over that key number of 1,300. Some technicals here. This is Bollinger Bands. We're climbing the Bollinger Band, but we're climbing the upper Bollinger Band. We're kind of losing momentum here. Again, gold can do that. It can climb the upper Bollinger Band for some period, some time. You can see that in some really big moves, that's exactly what it did. And that can last for a while. But this is a momentum indicator, and we're just starting to lose that momentum. This is particularly an indicator I like to use, a 14-week stochastic. If you go back to some of the periods where we really made a lot of money, 2005, 2006, 2007, in this gold market, that stochastic stayed above 80 for some period of time. Whether this is going to round off and stay above 80, again, the next 2-3 weeks is going to tell that tale. In the very Near term, we're on the verge of a golden cross. A lot of people look at that as a technical indicator. A lot of generalists come in when we have a golden cross. That means a 50-day moving average, in this case, rises above the 200-day moving average. We're really within a couple of dollars of that happening. That could give us a boost by bringing in some technical money. Doesn't always work. This is a period going back about 10 years of golden crosses. Some of them work very well. Even this one was okay. Some of them, however, like this one and this one, didn't work out so well. So about 4 out of 5 times or so, it ends up being a sign of a good rally in gold, but not always. Still, though, it's going to bring in some money, I think, if we do clear that technical burden. Gold stocks, as you can see, are still cheap. The gold stocks started responding to gold's move a couple of weeks ago. They've not done that over the last couple of weeks. That's one of the reasons some people, like Jordan was up here earlier, are growing a little bit negative on gold right now, at least in the near term. I kind of agree with that. I'm worried about the slowdown in momentum, but let's face it, that can change in a day. Gold bugs index over a few years, you can see that. Right toward the end there on this chart, we've kind of come back a bit. The producers are starting to come back. We need them to lead this move in gold. We saw a few weeks ago in late December, earlier this month, we saw silver and the mining stocks leading and offering leverage to gold's moves, which was very good, very encouraging. We haven't seen that over the last week or two. So now I am actually out of time, and I'm about to introduce to you some ways of taking advantage of this trend. Again, I think it's inevitable we're going to see higher gold prices. This is all my contact information. Please look me up or follow me on Twitter and listen to our podcast and come to our annual conference in early November.